Hi, welcome back to this fourth video in the set on the economics of foreign exchange and exchange rates. We've seen why people might demand Australian dollars and sell euro, and why people might sell Australian dollars and buy euro. We're now going to turn that into a demand curve for Australian dollars and a supply curve for Australian dollars. That will allow us to work out the equilibrium exchange rate, the Euro-Australian exchange rate. Then we're going to be able to analyse changes in government policy and how they affect the exchange rate. Just a reminder, there are three reasons why people would want to buy Australian dollars. First, they want to buy Australian goods or services. That's exports from Australia. Secondly, they need to buy some Australian dollars to send some income, like a dividend, to a person in Australia. That's income receipts for Australia. Thirdly, they need to buy some Australian dollars to invest in Australia, buy some shares in an Australian company, or buy some other asset like an Australian government bond. That's foreign investment in Australia. Similarly, there are three reasons why people would sell Australian dollars. To buy overseas goods or services, that's imports to Australia. To pay money to someone overseas, that's an income payment from Australia. Or to buy an overseas asset, that's foreign investment by Australia. All purchases and sales of Australian dollars falls into one of these three categories. Let's start by drawing the demand curve for Australian dollars. So here we have on the vertical axis the price of an Australian dollar in euro, the number of euro you have to give up to buy 1 Australian dollar. And we're going to have the quantity of Australian dollars down here on the horizontal axis. And the demand for Australian dollars will be shown by this downward sloping blue line. As normal, the demand curve shows us for any price of an Australian dollar, the quantity of Australian dollars that people would like to buy given that price or given that exchange rate. Notice also that the demand for Australian dollars is simply the sum of exports, income receipts, and foreign investment in Australia. Notice that unlike a normal demand curve, this demand for Australian dollars is what we call a derived demand curve. People don't demand Australian dollars or buy Australian dollars because they want them in their own right. It's not like buying a car where you want to drive the car, or some food where you want to eat the food, or a movie ticket where you want to go and enjoy the movie. You're buying dollars not because you want to eat, drink, or enjoy the dollars, but because you want to do something with the dollars. You want to buy Australian goods or services, pay someone in Australia, or invest in Australia. So the demand curve for Australian dollars is derived from an underlying demand for something else. That's why it's called a derived demand curve. And whenever you're dealing with derived demand curves, you've got to be a little bit careful because it's not obvious that they slope the right way. Let's check. For example, suppose the exchange rate goes up from, say, 0.8 of a euro to the Australian dollar to 1 euro to the Australian dollar. And let's think about exports. Suppose you're a European mining company and you want to buy some mining equipment from Australia. And let's say the Australian price of that mining equipment is 1 million Australian dollars. At an exchange rate of 0.8 euro to the Australian dollar, the 1 million Australian dollars that you need to buy the mining equipment will cost you 800,000 or 0.8 million euro. But after the price of an Australian dollar goes up to 1 euro, the price of the equipment is also going to go up. You're going to need 1 million euro to buy the 1 million Australian dollars to buy the equipment. So effectively, the rise in the exchange rate, the rise in the price of the Australian dollar, has made the Australian mining equipment more expensive to Europeans. And in general, a rise in the price of the Australian dollar makes products from Australia more expensive, and so people overseas will tend to buy less of them. They're going to tend to buy fewer Australian dollars because they're going to want to buy fewer exports from Australia when the price of an Australian dollar goes up. So we would expect the quantity of Australian dollars demanded at a low exchange rate to be greater than the quantity of Australian dollars demanded at a high exchange rate, or in other words, we expect the demand curve for Australian dollars to slope down. So it looks like the derived demand for Australian dollars is well behaved. What about supply? Well, here we have our red supply curve for Australian dollars, and of course it's just simply equal to imports plus income payments plus foreign investment by Australians. But does this derived supply curve actually slope up? Let's look at imports. What happens to the supply of Australian dollars for imports if the exchange rate goes from, say, 0.8 euro to the Australian dollar up to 1 euro to the Australian dollar? Well, suppose you want to buy a car. Let's say the car will cost 10,000 euro. You want to buy a car from Europe. Well, if the exchange rate is 1 euro to the Australian dollar, then to get the 10,000 euro that you need to buy the car from Europe, an Australian will need to sell 10,000 Australian dollars to get the 10,000 euro to buy the car. But if the Australian dollar drops in value, if the exchange rate falls down to 0.8 euro to the Australian dollar, then the Australian is going to have to give up more Australian dollars to get the 10,000 euro to buy the car. How much more? Well, you can work it out. 10,000 divided by 0.8 is 12,500 Australian dollars. So when the exchange rate goes down, the Australian will have to supply more Australian dollars. Oops. Doesn't that mean the supply curve goes the other way? Let's think about this a different way for a second. If the price of the European car goes from 10,000 Australian dollars to 12,500 Australian dollars, the Australian buyer may say, hey, forget it, it's gone up by 25%. I'm going to buy something else. I might go and buy a Japanese car. I might go and buy a car from Korea. I don't have to buy the European car. And of course, if that occurs, the amount of Australian dollars that they supply to buy the euro isn't 12,500. It's zero. They don't supply any Australian dollars to buy the euro because they're not buying euro anymore, because they've decided not to buy the European car, but to buy a different car instead. And of course, if they decide to not buy the European car, our supply curve slopes the right way. The number of Australian dollars they would like to supply falls, in fact it falls to zero as the exchange rate drops. The problem here is that the supply of Australian dollars for imports depends on two things. It depends on the price of the import, in this case a car, the price of the import in Australian dollars, and it also depends on the quantity of the imports. But as we've seen, when there's a change in the exchange rate, these two things go in opposite directions. So it's possible that the supply of Australian dollars could either increase as the exchange rate goes up, or it could decrease. Fortunately, we can make an assumption that will make sure the supply curve goes the right direction. As we saw in our example with the car, the supply curve will go the right way if the quantity effect is big relative to the price effect in Australian dollars. What do we mean by that? What we mean is that the percentage change in the quantity of imports has got to be bigger than the percentage change in the price of those imports in Australian dollars. But hang on, we've seen something like this before. This is our elasticity formula. If you've seen our earlier videos, then you'll know that this is the same as saying that supply slopes up if the elasticity of demand for imports is greater than 1. Now, before we use any assumption in economics, we should always ask, is this assumption reasonable? Well, I've got to admit, this one is not very convincing. Remember, we started off looking at an example of a European car. Why is the elasticity of demand for the import of European cars greater than 1? I see no reason why it has to be. Fortunately, we don't actually require this assumption to get the supply curve to slope up. In the next video, I'm going to talk about the other part of our supply and demand, which is foreign investment. We're going to find that foreign investment provides another pretty strong and convincing reason why demand for Australian dollars slopes down and supply slopes up. Now, if you just want to move on to the policy discussion, skip the next video, come back to it later if you're interested. If you want to get into the argument about exactly why the supply and demand curves slope in the right direction, look at the next video, it's up to you. But for the continuation of this discussion, let's work on supply sloping up and demand sloping down. Where does that get us? Well, if the supply for Australian dollars slopes up, the demand for Australian dollars slopes down, we expect the equilibrium to be where they cross, where the demand and supply of Australian dollars equals each other. That's given here by E star, or when I'm making this video at the beginning of 2018, the actual exchange rate is about 2/3 or 0.66 of a euro to the Australian dollar. And just a reminder of why this is a good prediction, it's because if the exchange rate was higher, then the amount of Australian dollars that people would want to sell would exceed the amount of Australian dollars that people would want to buy. There would be an excess supply and would expect the exchange rate to drop. If the exchange rate was lower, then the quantity that people would want to buy of Australian dollars would exceed the quantity people would want to sell, and you'd expect the price of Australian dollars to rise. So this is an excellent predictor of what the exchange rate is at any point in time. Of course, what we're really interested in here is to ask what changes the exchange rate and what does that mean for government policy. And that's what we're going to turn to in 2 videos' time. Talk to you then.